back to the real estate, mortgages. We talk a lot on the show about how hard it is to get a mortgage with a big lender, how challenging they are with understanding, you know, we had one this week from a big lender, and I'm not going to name any of the big banks, but we had one this week from a big bank, and the appraiser appraised the property $50,000 short because they used homes north of Kennedy for a South Tampa home. Okay, and they hired an appraiser that probably did it the cheapest. That shouldn't have been in that neighborhood. Didn't know what he was doing, and the appraisal came in short. Now we've got to fight it or figure out another solution for that client. But in reality, the downfall of that transaction started when the consumer picked the wrong mortgage lender. The big bank that said we'll give you this low rate and this low cost, and that's all great and dandy. But if the loan doesn't close and you can't buy a home, the rates and fees really don't matter because you're not going to pay any rates or fees because you're never going to own a home. So you know, you guys have some experience with that. So talk about Waterstone and what you guys do differently than a big bank does that helps loans get closed and still keeping fees in line.
Well, in fairness, as you know, I worked at a big lender for 24 years. I'm not going to mention which lender it was, but and in fairness to all lenders, you know, we don't control the appraisal anymore. So I mean, you know, we don't even get to talk to them. In the old days, and this is maybe part of the downturn. In the old days, you know, you'd call the appraiser and go, man, you better get your act together and give me my value, or I'm going to use another appraiser. You know, you can't even, you know. That's what. And
I think at the same time, though, sometimes the bigger, it seems like the bigger banks have more challenges on appraisal because I feel like they don't do as much to. You know, and I don't know how it's set up with the appraisal management companies. We just tend to have more appraisal issues with the bigger banks. So I know there's at least some sort of.
I think in general, the culture in the bigger banks is that we have the brand name. We're the big guy. We got most of the money, and we set the rules. And you know, they forget about the consumer. They forgot about the consumer along the way. Where a Waterstone, although we're traded on NASDAQ, is not a household name. So at the end of the day, if we don't take care of the consumer, we got nothing.
Right.
And so we have options, and we're more concerned about making sure the consumer's happy, because at the end of the day, we don't have a sign on every corner.
Right, and the goal also is to give the consumer the best service, the best advice, and get them in the best loan product. Not the loan product that makes you the most money, but the right loan product.
Yeah, we have a lot more maneuverability in basically getting things done. We don't have the same overlays that the large banks do. I mean, basically, we can go directly to Fannie Mae, directly to Ginnie Mae, you know, directly to get these loans done without the additional layers of red tape and all this stuff that the big banks put you through. But at the other point, I mean, rates and fees, I mean, we're actually better than the big banks as far as rates and fees. So, I mean, if people are going there for that, I mean, I don't think that really
makes sense. For convenience and understanding.
It's convenience and name recognition. Yeah. Now, here's the other thing, and I think this is kind of an important segue into, like what you were saying before, the maneuverability and all that kind of stuff. I think it's also about consulting the person and owning it, right? And really giving them the right advice versus the advice that's in the best interest of, you know, your boss telling you what to do.
Well, the nice thing is that we close in our name, but we have different investors. We can actually close, you know, actually have your loan sold to a big bank, you know, but a lot of times, again, because of the overlays, that's not the best place to put you. So
overlays, let's talk about that for a minute. The consumers listening to this may not have any idea. They're like, what the hell is that? What are these guys talking about? So let's explain what an overlay is really quick, so a consumer listening to the show knows they think we're talking about something highly inappropriate. Like an overlay. So we don't know what we're talking about.
Yeah, so basically an overlay, there are certain guidelines that have been put in place by the government, essentially, Fannie Mae, Freddie Mac, that are necessary to get a loan done and closed. And
sold to them.
And sold to them. And that's basically what controls the 95% of the market. So if these big banks, what they do is they take their guidelines and then they impose their own guidelines. That
more strict to protect themselves a little bit more when they really don't have to, because Fannie Mae says, I'll buy this loan. Yeah, but they want to be a little bit more restrictive because they think they can. They want to be a little more conservative.
And those change all the time. And so what you have are you have your loan officers or your underwriters and whatnot that are now underwriting to this nth degree higher, result, and a lot more documentation, a lot more back and forth, a lot more of the same documentation over and over again. I mean, mortgages are, we keep saying that they're easy. I mean, they are easy in a way. I mean, you have to fit the requirements, but
everybody's different. So the difference, like for Waterstone, for example, everybody's got different scenarios. Everybody's got a case-by-case situation. So, you have a situation that's case-by-case. You have these guidelines. Let's say that's what they are, guidelines. They're not black and white. But you have a situation that's black and white, and you really don't. The guidelines not super clear. So our underwriters will say, "Well, let me call Fannie Mae." Where a big bank underwriter says, "We just don't do that."
No, we're not going to touch that. Well, and I think that's what the consumer doesn't realize. They'll hear a lender, and this is really important. If you're listening, listen to this right now. If you are a home buyer and you were looking to qualify for a mortgage recently, and you got turned down by the lender you're speaking to, please call Waterstone. Please get a second opinion. I cannot tell you how often people come and say, "Well, I got declined by Fannie Mae or Freddie Mac or FHA." And it was an overlay that caused it. And the big bank will say, "Oh, well, you don't fit the guidelines," because so the consumer will think that they go to any lender and the guidelines are going to be the same. But it's the overlays that cause that a lot of times. So if you got denied, get a second opinion.
Yes.
I'm telling you, you may be able to buy, and you're just going off that information because a very conservative bank has very conservative guidelines, and you were just outside of their guidelines, not Fannie, Freddie, FHA, or VA.
So here's more of what we see. I mean, honestly, there's not a whole lot of competition with us and the big banks. I mean, people come to us because they know it's going to be a better process. Our fees and rates are already better than the big banks. What we're seeing is these people that want to go to these internet companies. Now, the difference between us and an internet company is that we're going to fund in our own name. We're still backed, even though we're a smaller bank than the large banks. We're backed by $1.6 billion in assets, so we're not that small. We're lending in half the states in the nation. I mean, we're good to go. What we are doing is closing in our own name, whereas these internet companies, who knows what
and
they're
it's
doing.
what you guys. What's interesting about your setup is it's kind of like a hybrid model. You have the good parts of the big bank and the backing and the financial side of it, to where you're not going to wake up tomorrow and go out of business. And then you have the good parts of the local side of it, where you got local loan officers that are only doing mortgages. Some of these banks have people that are, let me take in your mortgage application. Like it's crazy.
The credit
So
unions
yeah.
there.
So doing like 4 different jobs. Oh, I'm a loan officer and I clean the floors. Half the week I clean the floors, but I also do mortgages too. So you guys you're like that hybrid model where you got the best of both. But I can't tell you how often I hear from consumers say, "Oh, we got denied for our loan. We can't qualify." It's like, now you probably can't qualify at that lender. Talk to somebody else.
What really separates the men from the boys in the lending industry really is how good that loan officer is of structuring the loan. It's not just the rates and fees and guidelines. Not everybody's cut the same mold. It's you listen, you ask questions, and I'm just looking here. What's the best way to ease your process in the mortgage process? Be honest. So as a consumer, don't hold anything back, because it comes out later in the process.
I agree.
And usually it comes out the day before closing, and all of a sudden it's like, well, now we got
a problem.
Yeah,
And I completely agree with that. Well,